Hi guys, this is Constance from Zua. If you are a property practitioner today, the spotlight is on you because we're going to talk about audit requirements for property practitioners. According to the Property Practitioners Act, every property practitioner must be audited, whether or not they're operating as a sole proprietor, a company, a closed corporation, or a partnership. In other words, the legal form of the entity is not the determinant of whether or not you need to have an audit done. Now, which accounting records must be audited? Well, all business property practitioners whose annual revenue is 2.5 million or above must have their financial statements audited unless they have a PPRA issued trust account exemption letter, in which case they can have their financial statements independently reviewed, and we'll talk about that just now. Now, a property practitioner business is exempted from keeping a trust account if it has submitted to the PPRA in the prescribed affidavit format an affidavit asserting that it has not received or is no longer receiving trust monies, and undertakes as well to not receive trust funds without first having opened a trust bank account and also having provided the PPRA with evidence that the account has been closed and all funds have been properly dispersed. In a nutshell, we're saying if you're no longer keeping a trust bank account, and you no longer receive funds, then you can obtain exemption. Should you anticipate that you will start receiving trust funds, then you need to notify the PPRA in the prescribed format. So, audit versus review, what are the differences? A traditional audit by its nature is meant to provide a high or reasonable level of assurance to the user of the financial statements, whereas a review provides limited assurance. And a review can be provided by an accountant who is either registered with the SAICA, SAICA, or ACA, or CIMA. It is similar to an audit but provides limited assurance, as I said, to the third-party user. Now we want to look at some subtle differences between the trust aspects vis-a-vis the business aspects of an auditor. Now remember, an estate agency or property practitioner's audit covers both the business side as well as the trust side of the property practitioner's business. But there are specific procedures that focus on the different aspects of the audit in different ways. Now, on the business side, the auditor would perform sufficient appropriate audit procedures for them to issue an opinion regarding the income statement and balance sheet of the agency. Now, on the trust side of the audit, the auditor reports on the property practitioner's compliance with Section 54 and the relevant subsections of the Property Practitioners Act. They also report on Section 48 as it relates to the Fidelity Fund Certificate and Section 28 of the FIC, or the Financial Intelligence Center Act, as it relates to the Property Practitioners FIC. Now, FIC registration rather. So what is the focus of the audit? The specific audit procedures focus on interest, and the auditor will corroborate the interest that is reflected in the financial statements, either via bank statements or via what is known as an IT3B certificate, which you can get from the bank. From this interest amount, the auditor will deduct any interest that is paid in accordance with specific written mandates through express written mandates. Now, the balance of that interest, or the net balance after deducting the interest payable through express written mandates, is then paid or should have been paid to the PPFF, which is the Property Practitioner Fidelity Fund. So if you still have any further questions or you'd like to get in touch with us, these are some of our services, and you can get in touch with us on any of the platforms on the screen. I look forward to interacting with you or hearing from you. Thank you.